All right. Thank you so much, Robert. Glad to be here today. I always love working with Robert, and we send a lot of people his way that need help in the government contracting space. Um, and specifically today, we're going to be talking about small business size and affiliation issues, which is something that my firm works on quite a bit. And I'll give you some of it's going to be an overview of the affiliation rules. Some of it's going to be some tips, tricks, and best practices the for the actual size calculation world. A lot of these things are issues that if you kind of know about them going into um, your own size calculation, or you kind of know them going into it and can monitor them, then it's a lot easier, as with most things, than trying to figure it out after you've been protested, for instance. We'll talk a little bit about the size protest process as well. So you can kind of have a handle on what that means in the federal contracting world. Again, my name is Shane McCall. Our firm is Coperns McCall Potroff. We work with federal contractors all around the country and focus not exclusively, but we have a special emphasis with small business federal contractors. If you do want more information from us, or just want to get legal updates and things like that, we have a great blog, smallgovcon.com, which is a good resource for you to kind of dive deeper into some of these issues. And some of these rules change. We put case updates and regulatory updates, SBA and federal acquisition regulation updates. So it's a good resource for you there. We also have a newsletter you can sign up for to get a monthly digest of information, kind of the top blog posts from that month, so that you can get it straight to your inbox and stay informed that way. Today, we're going to be talking about lots of different issues, and I will say um, these things do change. The SBA rules do change. The size standards do change. So, of course, I'll mention some things in this on these slides, examples and things like that. Make sure you're looking at the most up-to-date version of size standards, SBA regulations, and things like that. Again, a resource like our blog, SmallGovCon, can be a good place to check out the newly updated things as they come in. And the other thing is, while I'm an attorney, this is just educational information and, you know, not legal advice for any particular situation. And I'll answer questions kind of in that same vein. So today we'll be talking about kind of the overview. What is a small business under the SBA and federal contracting rules? Some specific pointers on determining your business's size and the different types of size standards that are out there. And we'll kind of focus on a couple nuances of calculating size with a reference to a couple decisions from the past couple of years where people and companies either didn't provide enough information to the Small Business Administration, or they didn't provide the information soon enough, which is why it's always good to kind of have a handle on, okay, what are the issues that could face your business? What are the things you have to have a handle on going into um, making a calculation of your company's own size, or if it's reviewed by SBA. So we'll talk about some sort of cautionary tales, if you will, of a few companies that didn't quite have a handle or documentation or the right setup on some of those size issues. We'll talk about the basics of affiliation. There's a lot you could go into on each of the SBA's affiliation rules, but this will give you kind of an overview and a handle on what the big picture issues are. And then briefly mention some size protest rules at the end. There's a lot more to it, but it's good to know, okay, what are some of those key deadlines? What do I need to be concerned about in the big picture level? And then if any of these things give you concern or raise new questions, that's when you want to dive deeper into some of the rules, or reach out to, a firm like ours to get a little bit more information about your situation, the particulars of your company. Okay. And we'll pause for a brief poll question here.
All right. Our first poll question today, and let me
Sorry about that. Can you hear me, Shane? Having a technical issue on my side.
Oh, yeah, sound is good.
Okay, not sure what happened there. Launching our first poll question here. How confident are you with your current size determination? Not confident, little confident, somewhat confident, or very confident? Again, just a quick reminder, there will be 6 poll questions throughout our presentation today. You do need to respond to at least 5 of them in order to get credit, and those CPE certificates will be emailed automatically within about 48 hours after today's presentation. Leave that poll open for just a few more seconds here, and then we'll publish the results to the screen so everybody can see. All right, so taking a quick peek here. As often, we've got results across the board, but it looks like almost half the people are very confident, which is good. And as always, those of you who are somewhere between not confident and somewhat confident, highly encourage you to reach out to Shane and his team to help you move up to that very confident state. All right, turn it back over to you.
All right. Yeah, I do see. Yeah, that's good that people are confident about that. We sometimes deal with clients that are either they're approaching the top of their size standard, and sometimes that's where you need to start projecting out where your revenue is going to be, and if you're going to be close to the top of that size threshold, and look at these issues a little bit more. Other times it's when you have related companies, family members, or you have maybe a more complicated business structure. You've got a lot of different investment partners. Some of those things can sometimes bring in affiliation issues that I'll talk about in a couple slides. But definitely feel free to reach out if you do have more involved questions. So, some of this should be old hat for a lot of federal contractors. So I'll give you a little overview here. Size standards and what is a small business. So your size is related to your NAICS code, North American Industry Classification System. Those NAICS codes are established by the Census Bureau. There's actually a NAICS manual on the Census Bureau's website that you can search for that, and it provides the descriptions of the industry codes for all the industries in the United States and across North America, really. And those codes were originally designed for economic forecasting systems, not really for small business purposes, but they are used for the small business categories within the federal contracting system. So you got an example up there for engineering services. Each of these have these 6-digit codes, 541330, and that's literally the definition taken from the NAICS manual. They're fairly short for the most part. Companies that are engaged in applying principles of engineering in design, development, and utilization of machines, structures, processes, systems. So each NAICS code within the system has a 1 to 2 paragraph description of what that industry is composed of. And those things are updated. They update that manual every, I think it's maybe 5 to 7 years. So sometimes they reorganize the numbering system, something you got to keep track of a little bit. And then the other kind of place this can come into play, and I'll talk about this, is you can do a NAICS code appeal if you feel that the NAICS code assigned to a specific procurement is not the actual NAICS code for the work that best describes that is being procured by the federal agency in question. There is a process for that, and I'll mention that towards the end of this presentation. Okay, so then you've got this NAICS manual, it's got these codes, and then those all correspond to a specific procurement. So each procurement, each solicitation is assigned one NAICS code by the agency. The contracting officer gets to make that initial determination. As I said, you can challenge that if you want to, if you feel it's really off base. There's also, in some cases, you have a NAICS code assigned to a subcontract. For instance, if you're a large prime, has a subcontracting plan, they're going to assign a NAICS code to a subcontract as well. So it's used mainly for prime contracts, but can also be used in the subcontracting world as well. Okay, so then you got your NAICS code, and then SBA assigns the size standards for each of these NAICS codes. It's either going to be revenue-based or employee-based. The example there is the revenue-based size standard is $25.5 million. And an employee-based size standard is an example here for is manufacturing. Saw blade and hand tool manufacturing is a 750 employee size standard. Basically most of these services types industries are going to be revenue based or receipts based, and then the manufacturing industries are going to be employee number based. There's some odd exceptions here and there that have slightly different calculations. I think one is oil production. If you're in that industry, I think it uses barrels of oil. So there's some little exceptions here and there, but for the most part, you're going to be under those receipts-based size standard if you're doing things like construction or services. Manufacturing is going to be under employee-based for the most part. Okay, so that's a real quick overview of how the size standard system works within the federal contracting sphere, and then we're looking at how do you determine your business's size so you can be confident. Some of you already are, but you can just reinforce that confidence in your size calculation. And I will also note that it's a self-certification process for the size standard. So you're going into System for Award Management and you're self-certifying or checking a box that says my company is small. And then when you submit your proposal for a particular solicitation, you're also certifying as of that point that the size standard is accurate within SAM and that you fall under that size standard for the particular solicitation that you're submitting your proposal on. So you are making that self-certification. It's not something where it's checked by a government agency or anything like that unless there is a protest, as we'll talk about. Okay, so in terms of the general size issues, you got to look at the timing. So the general time to determine size is the date that the firm submits its initial offer with price. So if you're submitting a proposal January 3rd, 2024, that is the date to determine size. When you submit that proposal, you hit send on that proposal. That's your self-certification that you are small at that time. That's also the date when SBA determines size. If there's later actions within that procurement, they typically won't affect your certification. It typically goes back to that initial offer with price. There's some exceptions here and there for different types of procurements. Two-step procurement like the design build, I believe has a slightly different rule, but for the most part, it's initial offer with price. And then you can sort of keep that size standard, and your size standard or your size will relate back to that date of initial offer with price. You're generally considered small for the life of the contract up to a 5-year period. After 5 years, you would have to generally recertify if it's longer than a 5-year contract. And there's another exception to this rule. If you have an IDIQ contract that's going to have task orders under it, then the contracting officer can request size recertification for a specific task order. And that should be very clear from the task order request for proposal. It will say you must recertify to your size as of the time you submit your proposal. If it doesn't have clear language on that particular task order, then your size still relates back to the date of the initial offer with price. But I've definitely seen task order proposals that do have that request for recertification. It doesn't have to have any magic language either. It doesn't have to have certain language that says it. It can be phrased in different ways, but it has to actually request that the company certify as to its small business status as of the date of its submission of the task order.
Hey,
So,
Shane, we've got a couple of questions that have come in here that I think are relevant
oh,
to this
perfect.
part. First one is, when will the SBA reassess the size standard?
Oh, okay.
So like they just recently changed,
Mhm.
those, what the dollar amounts and employees are. How often do they do that?
Yeah, that is a good question. They have to do it at least every 5 years on like a
Okay.
rolling basis. So they do 1/5 of all the size standards have to be reassessed every 5 years. But they can
Okay.
also do it more frequently than that. Like you probably saw December of 2022, the SBA increased all of the receipts-based size standards by over 13% based on inflation. And so they just did that across the board because they sort of they have the mandate to do it every 5 years, and then they have an additional ability to reassess those and
Okay.
see if it's still accurate. And interestingly, they can actually reduce the size standards, but every time SBA has the opportunity to do that, they have declined because that would
Okay.
then kick a
Sure.
bunch of people out, and they say, "Well, we'll just leave it how it is."
Right.
Yeah, good question though.
So, next question is, excuse me, the 5 years that you're referring to on the slide here now, has that always been 5 years, or was it 3 years at one time?
Yeah, it used to be a 3-year look back period. That is slightly different than what I'm talking about on the slide here. On this slide, I'm talking about um, a contract that has a 5-year period of performance. So you could have a 1-year
Okay.
base year and then 4 option years. If
Okay.
it's longer than that, probably seen 10-year um, contracts that go 10 years. At the end of the first 5 years, you have to recertify as small before you can kind of get that option for the 6th year. But yeah, it used to be and I'll mention this on a slide, but yeah, it used to be a 3-year look back period for determining your size based on receipts. And then for a while, there was an option you could do 3 or 5-year look back period. And for I think a couple years now, it's been you have to use a 5-year look back period.
Okay.
Which is a good question because I still hear from people. Wait, I thought it was 3 years. I thought it was 5 years. I thought you got to choose. I think it was January 6th, 2022. They said nope, has to be 5 years. And that was actually a rule that Congress put in place, so SBA couldn't really. They
Okay.
eventually had to use that 5-year look back period.
Great. All right. Thank you.
Oh, very good. Okay, so yeah, that's that. This is the 5-year look back period that we were just talking about. That's what you have to use for a receipts-based size standard or revenue-based size standard. SBA calls it receipts. It's equivalent to revenue, and so there's not all of these regulations I'm talking about are fairly short. There's not a like an additional policy manual or anything like that. There is decisions that come down from SBA Office of Hearing and Appeals, the administrative law judges at SBA that interpret these regulations, but there's nothing quite as fine-tuned as some of the things you might see in the accounting world. Cost accounting standards, something that would be in Robert's wheelhouse. When it comes to accounting for some of these size issues, there's not a lot of policy guidance or manuals or handbooks or that sort of thing. It's all either just the basic regulation and then the interpretations from the SBA judges. So we kind of that's what I'll mention some of those interpretations that guide how you can look at these calculations. So generally, your receipts is your taken straight from your tax returns. It's your total income plus cost of goods sold is how SBA defines that, and then they link that to the IRS definitions on the tax returns. So SBA wants those companies to look to the tax returns to get that information. Um, various tax returns are listed there in the regulation, depending on what kind of company it is. And then interestingly, of course, there's always situations where people don't have their tax returns done or it's on extension or something like that. So SBA can look at other information such as financial statements if those taxes haven't been filed. Because sometimes I'll get a question from a client, prospective client. They say, well, we don't have to count that last year, right? Because we haven't done our tax returns. No, if you do, say you have an annual, you use the calendar year for your fiscal year, and you have a proposal that's due again January 3rd, 2024, then you have to use the 5 prior years before the year in which you are submitting your proposal. So you'd start with 2023. Doesn't matter if you don't have your tax returns done yet. You have to approximate what the tax return would say based on your financial statements. And then, internally, you'd have to do that in order to self-certify as small when you submit that proposal on January 3rd. And then if requested by the SBA, you also have to produce those financial statements and show how it's equivalent to your tax returns. And I've dealt with, for instance, like a Native American tribe. They're not required to file tax returns because of their status, and they have to use financial statements as well to show their small business status if it comes up. So that's the general mechanics of the receipts-based size standard. Again, looks to the tax returns, can use financial statements if the taxes haven't been filed. But it's not, you can't just say to the SBA, well, hey, I can't get that to you. I haven't filed my tax return yet. It's on extension. That's the type of thing where SBA will say, sorry, you got to come up with this information on a very short time frame, and you have to do, what you can and provide what you can to the best of the ability of the company at the time it's requested by SBA. Okay, so total income plus cost of goods sold. It's a very kind of simple math problem based on your tax returns. And then sometimes people think, well, wait, there's all sorts of things that are on that tax return. They shouldn't count for my size standard. SBA has, in their regulation, they have a few exceptions to that total income plus cost of goods sold calculation, but they're very narrow and they're strictly enforced, meaning if it's not directly within these exceptions, then SBA isn't going to just allow you to kind of argue your way for it or expand these limited exceptions. So net capital gains or losses is one of the exceptions. Taxes collected for a taxing authority if they're in the gross or total income. And I have seen an example of that with a client when it was a sales tax that had to be included in income and then sent back to the taxing authority. SBA did accept that as an exception to income. It's not, I haven't seen it to be that common, but I have seen that come up. And then the one I have bolded there is inter-affiliate transactions. Not actually what it's technically called in the regulation. The regulation says proceeds from transactions between a concern and its domestic or foreign affiliates, which SBA commonly refers to as inter-affiliate transactions. That is a fairly common exception to these receipts-based size calculation. I've seen that come up quite frequently, which is why I'm going to talk about that one in a little bit more detail. And then the last one is amounts collected for another by travel agent, real estate agent, etc. If you're in that industry, that actually may be applicable, but there's not a lot of case law, or haven't had that come up too often. But if you're in that industry, then definitely look into whether that might be applicable to your situation. Okay, so we'll talk a little bit about inter-affiliate transactions in a second, but the employee-based size standard is the other main type of size standard that SBA uses. We've been talking quite a bit on receipts-based size standard for services types NAICS code. This is the manufacturing uses this for employee-based size standard, but also another common one is if you are a reseller, if you're selling goods to the U.S. government that are manufactured by another, you can count as a small business under what SBA calls the non-manufacturer rule, which also uses an employee-based size standard of a 500 employee-based size standard. And so if you're under those sorts of size standards, you're going to use the average number of employees based on the pay periods that fell within the preceding 24 months. So interestingly, this one used to be a 12-month look-back period, and similar to how the receipts-based look-back period was increased from 3 to 5 years, the employee-based look-back period was recently increased from 12 to 24 months. So if you're in that category, make sure you're using the 24-month look-back period now. Employees can be full-time, part-time, those from a temp agency, volunteers are not employees, and one I will highlight, contractors are not employees, and this means if you have a 1099, someone that's paid through 1099 is an independent contractor, they will not be treated as employees. They will be treated as a subcontractor of one person subcontracting shop that is not an employee of the company. So just something to keep in mind. That comes up in other areas of the small business rules as well.
So we've got a related question here. It says, can a prime contractor use the business size of a subcontractor at award as applicable through the life of the subcontract, or is it size redetermination needed through the life of the subcontract?
Oh, yeah, that's an interesting one. So I will say if you're, okay, so this is kind of getting into a couple other rules, but basically if say you're worried about the limitation on subcontracting, which is kind of maybe what this question is getting at. And that's the idea that small business prime contractor has to do a certain amount of the work and can't subcontract the entire value of the contract to a sub that's not similarly situated. So for purposes of what's similarly situated, and that would be if you've got a small business prime and you're subcontracting to a small business subcontractor, that's similarly situated because they're both small business entities. If it's an 8A set aside, you got an 8A subcontractor, those are similarly situated. And actually SBA's rules say that if the status of that subcontractor changes throughout the life of the contract performance period, it does have to be redetermined through the life of the subcontract, which I don't really like that rule because it requires a lot more monitoring, surveillance on the part of the prime contractor. Like we often put a provision in your subcontract that says you have to notify the prime immediately if there's any change in small business status. And also it's just inconsistent with what I said earlier, which is generally size is determined as of the date of the initial offer with price. I don't know why SBA has a different rule that's conflicting with that for subcontractors, but unfortunately they do. So you are supposed to, a small business prime is supposed to keep track of its subcontractors' size throughout the life of the contract, throughout the life of the subcontract. So that's a really good question. And kind of gets down into the nuances of the limitation on subcontracting. Okay, so that's employee-based size standard, and we'll have another poll question here.
All right, let me launch this next poll. Question is, a receipts-based size standard generally looks back how many years? 6 years, 1 year, 3 years, or 5 years? And again, we'll give you about a minute to answer the question. And great questions coming in. Please take advantage of that Q&A panel. We will answer as many questions throughout as possible and try to get through the remainder at the end of today's presentation. Okay, we'll give you just a few more seconds to answer the question, and then I'll publish the results here. All right, and we'll go ahead and publish the results. It does look like most people were paying attention. The answer, again, for the receipts-based size standard is D. David for 5 years. All right.
All
Turn
right.
it back
Good.
over to you.
Yeah, good. And yeah, good question from the audience on that one. Okay, so I mentioned inter-affiliate transactions as one of the kind of more common areas that's an exception for receipts-based size standard. And of course, this wouldn't apply to employee-based size standards because you don't have really proceeds back and forth in terms of employees. But it would apply, and is fairly common. It applies to um, transaction between a concern and its domestic or foreign affiliates. And I'm talking about affiliation rules at the end of this presentation. So if you're not familiar with some of those affiliation rules, the basic, the most common affiliation rule would be a parent and subsidiary company. Because the parent owns a subsidiary company 100%, those two companies are affiliates. This is SBA's rules for affiliates. There's the term affiliate is used in other contexts. I think, like IRS rules may use it or something like that. But we're talking about small business administration rules. So say you have a parent company and a subsidiary company, and those would be affiliates under the common ownership rule of SBA's affiliation rules. So, and what this says is that SBA should not count those receipts, at least should not count them for both of those companies, because that would be double counting. So the example here is in this situation, you had I think it was one company had a common owner. The person owned the company that was the federal contracting company, and then owned a separate company that owned real estate that then rented that real estate back to the federal contracting company. And SBA, in reviewing this, said, yeah, you shouldn't count these receipts twice based on payment of the rental, the lease payments from one affiliate to another, and those should be excluded as inter-affiliate transactions. So that affiliate company got the rental income by leasing that real estate to the protested company. So the protested company was the one seeking, to win an award on a small business set aside, and this got protested. And then SBA has to actually look into all these questions and get the answers from the protested company, or SBA always calls it protested concern. And in this case, they said, yeah, that's an inter-affiliate transaction. You shouldn't double count it. Now, the money comes into the one company and you count it on its tax returns at that time. And then if it's then paid to the affiliate company, it doesn't have to be then counted also as a receipt of the affiliate company. So you don't have to, it's all about avoiding the double counting of receipts between affiliates. And of course, if you're doing that, you're admitting the two companies are affiliates. So, you have to be ready for that and understand what affiliation is in order to make this determination. But if a company, is getting close to the top of their size standard and they have affiliate companies, it can be the difference between still qualifying as a small business and having to then compete as a large business if you can exclude these inter-affiliate transactions. And so if you're going to do that, though, where people get into problems is if they try to assert, hey, I've got all these inter-affiliate transactions. There's, giant amounts of money going back and forth. You shouldn't count those twice for both companies. Where companies get into problems is if they're not providing timely documentation and allowing SBA have enough information and provide it at an early enough time in the size determination process for SBA to make that determination. So in this example, it's from a few years back. This doesn't come up. Inter-affiliate transactions is not something that comes up within SBA's case law like every year. Although a lot of times you assert these things at the size protest level, the initial level of size protest review at the SBA area office. It's not going to become a published decision. So these only come about where either somebody didn't provide proper documentation, and then they appeal it to SBA's Office of Hearing Appeals. But just in the past couple of years, we've asserted inter-affiliate transactions for our clients, and those were accepted by SBA, or in one case it was through Federal Aviation Administration, which kind of has its own set of rules, but it was also accepted at that venue as well. Okay, so in this case, though, the company had an issue with, they called it management fees. So the tax returns apparently had an item labeled management fee on the tax returns, and the company, submitted those tax returns to the SBA, but it wasn't obvious, and the company did not kind of spell it out for the area office that those things labeled management fees were actually payments between two affiliated companies. There was just no explanation of that. And then later on in the process, the company provided a letter from their accountant, and it sort of provided this explanation that the quote unquote management fees were actually payments from one company to another affiliated company, rather than, if you make payments to a third party, such as an accountant or a lawyer or something like that, or you make payments to an unrelated subcontractor, those are not inter-affiliate transactions because you're not affiliated with your attorney, and you're not, a company's not affiliated with its subcontractor. So all of those sorts of payments are not counted as intra-affiliate transactions that you can take out from this calculation. So late in the process, the company tried to provide this letter from the accountant explaining what these management fees are. The first line of review, the area office did not take kindly to that argument, and so the company appealed it to the Office of Hearing Appeals, which also rejected the argument and said it's unrealistic and unduly burdensome to expect the area office, which is part of SBA, to have gleaned that something labeled management fee might constitute an inter-affiliate transaction. So take-home message there is, if you want to assert these sorts of exceptions, you have to know going in what they are, track them, and be ready to document and explain it to the SBA area office if there is a size protest. I mean, you want to have it documented for your own records as well, because you're doing that self-certification, but you definitely have to have it ready if asked for by the Small Business Administration.
So we have a couple of, sorry, we've got a couple of questions that have come in, and as I figured around some of these. The first question, if the highest level of ownership of an entity is a large business, is the wholly owned subsidiary always a large business as well?
Well, if it's if the highest level entity is like the majority owner of all the downstream companies, or the sole owner, then yeah, that large business would control all those downstream entities, and then they would all count as large businesses as well. It could depend, though, if there's like minority ownership positions in different companies, then it gets much more complicated. But yeah, it could, if it's just 100%, now I will say, when you say large business, we're talking about based on receipts. So there's a situation I've run into. A nonprofit company is considered what SBA calls other than small business. So it's not other than small based on it making too much money. It's other than small because it's not a for-profit business. So you could have a subsidiary of a nonprofit, and the subsidiary is for-profit, and it can qualify as a small business, even though its top-level owner is a other than small business. But if you have a company that's like very large, making $5 billion a year, and it's 100% owner of a subsidiary, then that subsidiary would not count as a small business.
Related question, if a parent company owns several subsidiaries and each subsidiary is its own company from an operating standpoint, are all the subsidiaries considered affiliates from the SBA's perspective?
Similar to the earlier response, if if it's majority ownership, then they would be considered affiliates of that parent company. And generally, because there's common ownership with the parent company, then all the subsidiaries would be considered affiliates of each other, assuming it's majority ownership. I've definitely looked at situations where if you have a small percentage share, then that could definitely change, and it gets a little bit more complicated in that situation.
The last question, what is the sustain percentage for size protests?
Oh, that's an interesting one. I think there was actually a recent Inspector General report where they looked at how many size protests there were. I don't think it was incredibly high. I don't recall the exact number though. I think if you reach out to me, I can send you. I think we did a blog post on it. Now, interestingly, I think there was like something like maybe 300, 400 size protests in a couple of years. So they're not that common, but for socioeconomic protests, interestingly, the sustain rate was higher than for small business size protests. So,
Thank you.
really good questions. Okay, so this is kind of a continuation, and this is a bigger point if you're ever in a situation where we're responding to the SBA, when it comes to inter-affiliate transactions, you have to provide, explanation and documentation, but that also applies to other aspects of this. If you don't, SBA has a rule for their size protest that if you don't respond adequately, then SBA can presume that the information that you failed to provide would show that the company is not a small business. It's called the adverse inference rule. I mean, they have that in other administrative legal procedures as well, but it's definitely something that SBA relies on quite frequently. Similarly, then you want to provide documentation for inter-affiliate transaction as well. So in this case, they talked about accounting methods, CCM and PCM. That was just a particular accounting method within that company. And then they said, hey, this showed that these are inter-affiliate transactions. And then that was rejected by the SBA, and on appeal that was upheld because the company did not provide this explanation early enough in the process to show that these were inter-affiliate transactions. And when we've had our clients do that, it's providing the actual transaction list of every transaction, for a period of up to 5 years between the two companies, showing the amount, date, and what the transaction was. It can constitute a lot of information, and that's what you've got to provide to the SBA to properly claim inter-affiliate transaction. All right, we've got another poll question.
All right, this is our third poll question today. True or false? To claim an exception for inter-affiliate transactions, a company must provide accounting explanation and documentation to show the inter-affiliate transactions. All right, looks like most people have voted. I'm going to go ahead and publish the results. And so 100% everybody is saying true. Right? In order to claim the exception for inter-affiliate transactions, you're going to have good accounting records and explanation to be able to support that. All right, turn it back over to you, Shane.
Yeah. It seems very clear. Although when this comes up in the decisions with SBA, it's because the company usually did not provide it at the first instance when they had the opportunity to do so, and then later tried to present that information or claim that it wasn't necessary or something like that. So it seems obvious, but then it's a kind kind of pattern that people don't provide it to SBA. So another nuance or aspect of receipts-based calculation is joint venture receipts. So this is an SBA compliant joint venture under SBA's rules. And so for accounting, when I say accounting, I'm talking about size calculation accounting. For doing your size calculation when you have joint ventures, you only have to include, but you do have to include the proportionate share of joint venture receipts. And that would be based on the percentage of work performed by each joint venture partner for that particular contract. So typically you might have, you have a small business joint venture with a mentor, a large business mentor, SBA approved mentor protege agreement. And the small business does 40% of the work for a particular contract. And then the large business does 60% of the work, for instance. The joint venture, the small business only has to include the 40% of the receipts from the joint venture as its receipts for purposes of size calculation. So it is a way to kind of not have to count as much of the receipts for a small business contract if you use a joint venture approach. If instead that same small business subcontracted to the large business, the small business would have to count 100% of those receipts as the prime contractor versus the 40% in that example as a joint venture member. And that can be a way to sort of help your company stay small if it is getting close to that small business threshold. Same or a similar rule does apply to employee-based size standards. You have to include your proportionate share of the individuals employed by the joint venture, which is the same percentage as the JV's ownership in the joint venture. So it's a similar rule, but it doesn't look at work share for employees. It looks at the percentage ownership in the joint venture. So keep that in mind if you are using, joint ventures to go after small business work. You only take the proportionate share of receipts and employees. Okay. So there's a couple brief examples for this proportionate share rule. It does only apply to a joint venture as defined under SBA's rules, and those are at 121-103. So that's a small business defined joint venture, not just you can have a joint venture under state law that's not compliant with SBA's rules. That proportionate share idea only applies to an SBA defined joint venture. So you can't take advantage of those, of only having to basically take a portion of the receipts unless it's an SBA defined joint venture. And then similar to the inter-affiliate transaction rule, you have to demonstrate what that proportionate share is of the joint venture receipts, show that those are reflected on the tax returns, and show what has to be backed out. Demonstrate that to the to the SBA, provide enough documentation that they can understand that, and you have to do that at the size protest level. Similar to inter-affiliate transactions, you have to document that, explain it to SBA. You can't do that on appeal. You can't do that after SBA has asked for it. You got to do that at first blush when you're responding to SBA in order to use that proportionate share. In this case, the company did not provide that information and did not show that it wasn't, that it was different than what was on the tax returns. And so they were not allowed to then exclude more of the joint venture receipts. Okay, got another poll question here.
All right, poll question number 4 on your screen now. What share of joint venture receipts must be included in a company's receipts for size purposes? None, all, proportionate, or aggregate? I'm going to ask a question here related to this. Does it matter or change the calculation if the JV is populated versus unpopulated?
Yes, it does. It does change it, I believe. So when I talked about the using the proportionate share as the work share of the joint venture that gets attributed to each joint venture member. That applies for the typical unpopulated joint venture. A recent SBA rule change allows for populated joint ventures. In that situation, it's based on ownership percentage, I believe, is how you calculate the joint venture proportionate share. That is, kind of a recent rule change. But yeah, if you've got some populated joint ventures, some unpopulated joint ventures, definitely need to look at those closely for the different way you calculate that.
All right. So publish the results on the screen. 100% everybody selected C, Charlie, for proportion. And turn it back over to you.
All right, very good. So that one makes sense to everyone. Again, got to be able to track it, show it to SBA, also track it for your own internal purposes. When you're doing your self-certification as small, you would have to do the same. You're supposed to do kind of the same thing you would show to SBA. You'd kind of have that in your internal file and rely on that when making your small business status update. Okay, so we made reference to affiliation in quite a few of these size calculation rules. So we'll kind of go over the basics of affiliation. There's a lot of kind of nuances within each of these rules. So just kind of give you the big picture. And then when it comes to your own company, you've got to investigate it more deeply on the actual the actual facts of your company. But just generally, SBA's affiliation rules say the two businesses are so closely related, one controls the other, that SBA is going to combine the size characteristics of both companies. So if it's receipts-based size standard, it's going to include the receipts of both companies, add them together. When looking at the size of one company on its own, it's going to add them both together. SBA's rules say that the most important thing to look at is control. Does one firm have the power to control the other? However, when you look at SBA's rules, they don't all, I would say some of them are not common sense rules. They're SBA rules about what control is. And you have to play by SBA's rules when you're dealing with small business issues. Now, affiliation is not in and of itself inherently wrong. There's nothing wrong with affiliation. It only matters if it makes a company ineligible for a small business set aside, or similarly for socioeconomic set aside. If you're not a small business, you wouldn't qualify for a socioeconomic set aside either. So affiliation only really matters if it impacts your size. You could be affiliated with many companies and still be a small business, but you want to be aware of that and know that you've got to track not only your own company's size standard, but also the size standard of those affiliated companies. So in many cases, affiliation is fine. Just recognize it, be aware of it, and track the sizes of those two companies. Okay, so I'm going to briefly go over the affiliation rules here for each of these types of rules, and then I'll throw some examples out there too. Some of them are, common sense and fairly probably obvious to a lot of people. Others are less obvious and sort of less common sense. So the most common one that people are going to deal with, and that we've already touched on, is common ownership. If one person or entity owns 50% or more of two other businesses, then those two businesses are automatically affiliated. And notice this rule is an automatic rule, and it is 50% minimum. So under SBA's formulation, then if you have two 50% owners, they both control the business. It's not like one controls more than the other. SBA's rules say that both of those owners would control the business. And then the sort of sub rule to common ownership is the situation where if you don't have a majority owner, or you don't have a 50% owner. So if you don't have one 50% owner or two 50% owners, and you have a bunch of minority owners, SBA's rules say the largest minority owner is going to control that business. If there are two minority owners that have a similar percentage ownership, then SBA will say that both of them control, even if one is higher than the other. Which I know that rule is one of those where it doesn't quite. People say that, that doesn't quite seem common sense, but it is how SBA interprets this rule. There's been situations where you had, 100 owners, they each own 1% of a company, and SBA said all of them control because they all have equal minority shares. So every one of those owners is in control of that company. If any one of those 1% owners had another business that they owned, it would be also affiliated with that company. And then if you do have a publicly traded company, there's an exception for that. Then it's the board of directors or the CEO or president based on the operating agreement or bylaws of the company. Now that doesn't apply though. If it's privately held and there's just a lot of owners, that doesn't apply in that situation. It has to be actually a publicly traded company. So yeah, that is the basics of common ownership. Remember, if it's 50% or more, each of those 50% owners controls the business. If there's no majority owner, then it gets more complicated, and you look at the minority owners, which one is significantly more than all the other minority owners, or if there's an equal amount, if there's two minority owners that are similar in size, then they would both be presumed to control the business. Okay. Present effect rule. The basic idea there is that SBA will presume that options and agreements to merge will be considered to be already exercised when SBA examines them. And sometimes this will crop up if you have a letter of intent or an agreement that one company is going to buy another company. Depending on the terms of that agreement, SBA in some cases will say, yeah, even though you haven't finalized the deal and crossed every T and dotted every I, will consider that acquisition to have already occurred. And so that's something you need to look at. If the company is is seeking to bid on small business set-asides and also pursuing a merger or acquisition, you may have to be careful with how you word some of these agreements when you're thinking about bidding on a small business set-aside. Now, again, that would only matter if the merger or acquisition would render the company other than small. So if you're buying a company and even if you include all of its receipts, the company would still be small, then it's not really a big deal for small business purposes. Okay. Another of SBA's affiliation rules is called negative control. And the idea here is that within the bylaws or operating agreement of a company, say you have a majority owner that owns 51% and a minority owner that owns 49%. The 49% owner will have certain voting rights or veto powers over the actions of the company. If the SBA views those veto powers as covering ordinary or day-to-day circumstances of the company, then SBA may take the position that the minority owner actually controls that company. And there's a whole sort of list of items and actions that SBA has said are okay for the minority owner to have veto power over. And then another list that SBA has said is not okay. Extraordinary circumstances are things that it's okay for the minority owner to have a veto power over. And those are things such as adding a member, declaring bankruptcy are a couple examples there. Unfortunately, SBA does not have a nice published list of these. They just come up in the case law over the years, and SBA said, yeah, this one's extraordinary, this one's ordinary. So I have had that come up. I had a client where they had a minority owner. They had like 10 actions that said the minority owner gets to veto any of these actions. And SBA said 9 of the 10 are extraordinary. It's fine to have veto power over it, but 1 of the 10 is ordinary. And therefore, we're going to find negative control, and any companies that the minority owner also controls will be affiliates of that company. So it comes in there. you kind of have to review your operating agreement bylaws if there is a concern about that, and go through them one by one based on whether there's extraordinary versus ordinary actions. Again, not really a common sense application of that rule, and that's not really spelled out in SBA's regulation either, which is unfortunate, but it is how they apply that rule. Okay. So then SBA has a series of rules that they call identity of interest. And these are based on sort of two companies that are so identified with each other that SBA will count them as being affiliates, even though there's not as clearly direct control like there is in the ownership situation, the ownership example. The one that sometimes can trick people is the family member affiliation or familial affiliation. And so this one is fairly direct. It says if you have companies that are owned by immediate family members, which can be sibling, spouse, parent, child, SBA will presume those two companies are affiliated if they do business with each other, if they have a business relationship that's fairly significant. It can be rebutted if you show what SBA calls clear line of fracture. However, that typically means it's a little bit circular because SBA says, well, if you show you don't have any business relationships, you don't do business together, or that you've basically stopped talking to each other 20 years ago, then we can accept that there's a clear line of fracture. So um, it can cause problems if you're not aware of that rule. If you have two companies, two brothers, for instance, that own construction companies, that comes up a lot in the case law. Are they doing business with each other? Maybe they need to be careful about doing business with each other if affiliation could cause one of those companies to be no longer a small business. And so it definitely can come up, especially if you got people working in the same type of industry, same line of work. They've done a little business together. You got to be careful with that sort of arrangement. Economic dependence is a kind of specific example. And SBA says if a company gets 70% or more of its receipts from another business over the prior 3 fiscal years, SBA will presume the two companies are affiliated. Typically, this would be, you got a large business prime, small business sub. The sub's gotten over 70% of its money from the large business prime. That would basically meet this presumption. There is a way to argue against it, to rebut it if it's a very new business that hasn't been around for very many years. There can be an exception to that. And then the last type of identity of interest rule is called common investments. And this one, again, it's an area where I wish SBA would be more clear about it, but it's one of those where you have to kind of glean what SBA means from its decisions over the years. And what they've said over the years is that so you got two people, they're doing a lot of investments together. It has to be two or more common investments. They have to be substantial to each of those individuals or entities based on the kind of their total portfolio, and the actual investment has to be substantial. So might not apply if there's a very, like a 1% investment in a bunch of different companies. One of those where you have to look at the specifics of the investments of those two individuals, and kind of evaluate it on a fact by fact basis. So unfortunately, that one has not been too well defined by SBA over the years, and you got to look at the situation of the companies, the amount of the investments, the total portfolio, percentage of the investment, and all of those things, and kind of put them all into the mix, and then SBA will determine if it views them. The idea there being that if two people are investing so much together that they are going to be kind of acting in concert. I'd say it's definitely more common if you own a greater percentage share of investment and a greater dollar amount and a large number of investments together. So those are all the identity of interest affiliation rules.
So we've got several questions that have come in here. And also just taking a look at our time and what we're going to get through today. First question is, how does SBA look at a USA sub that's owned by a foreign parent when it is consolidated in a different currency in order to determine size? Are they looking at the sub in US dollars and the parent in Canadian dollars in this example?
Huh. That's a good question. I don't think I've ever researched that one, but I think it would be that SBA would convert it to US dollars, but I don't know that one. I haven't looked at that one recently. Good question though.
So we'll have all of these questions. We'll make sure that Shane gets a copy of them and can provide some additional details later. So crossover to accounting question for me is common ownership / control / affiliation irrelevant for establishing separate indirect cost rates between entities, divisions, and affiliates? Great question. I would say yes, right? When we talk about calculating indirect costs and setting up indirect cost rates, we're looking at the individual legal entity. And I would say this, the other thing that I would add to that would be in a situation where you have two or more entities, and either one of those entities is providing home office or what we call sometimes shared services. Some entities we see operate those out of a separate legal entity, so they'll actually have a separate home office or shared service legal entity. Sometimes they will do that within one of the entities. But I would say there's no, in terms of determining affiliation, that's not a factor here. Next question, what if a mentor protege and mentor give you work?
Well, there is an exception to affiliation for assistance provided by an approved mentor to protege. So there actually was a case where that mentor protege exception was applied to the familial affiliation rule, but you got to be careful on kind of the timing of that. In other words, I think it was like a mother and daughter both had companies, but one was the mentor and one was the protege, and that was allowed to be an exception to affiliation. So that can actually help in that situation.
And lastly here, what if you don't have employees, you use a PEO to provide employees? Are they still considered your employees for the headcount?
I don't believe so. There is some specific rules. You know, if it's temporary staffing or PEO, that those I believe won't generally be considered employees. Or you won't be affiliated with the PEO. As to whether they're considered employees, I think it depends. I mean, I think it depends on a couple of the factors in there. So there's a whole SBA policy statement and nuances in there.
It seems like they would be, I mean, whatever employees you are leasing would seem to be counted as your employees. And I agree with you, Shane, that just because they're technically the employees of the PEO, that you would not get affiliation from these other unrelated companies, right? Because there's no, if we go back to the other things we've talked about, there's no ownership or control by any other companies that are participating in the PEO.
Right. Yeah, you definitely don't have affiliation with the PEO itself. But I think that you couldn't just use, like, if it's temporary staffing, the SBA doesn't want you to just say, okay, yeah, I have no employees because I'm using staffing agencies, and I believe you still would have to potentially count them. But it's different maybe different with the PEO.
All right, I'm going to turn it back over to you so you can get through. We've got about 15 minutes left. Try to let you get through some
Oh,
more
yeah.
info.
Yeah.
And then,
Well,
yep.
yeah, I was going to say, Robert anticipated there'd be some good questions here. And so I'll have to jump through a couple of these things just to get you a little bit more information here. You were
And if we
ready.
don't get, yeah, I was gonna say, and if we don't get through the slides on here, all of the slides are available in your download. We'll also have all of that in the follow-up email that goes out. And again, as always, you can contact Shane directly with additional questions.
Oh, for sure. Yeah. Reach out on LinkedIn or email. And sometimes I can shoot you a blog post or something that can get you started pretty quickly. Couple other affiliation rules before we go to some examples. So common management is when you have an officer, director, or a high-level person. So for instance, CEO, typically someone with the word chief in their designation, CTO, COO, or something like that, or a director. If they're have those positions at multiple firms, SBA can find affiliation even in the absence of ownership. So again, common ownership, people say, okay, yeah, I think that makes sense to everyone on a basic level. And then you say, well, wait, I could be found affiliated with another company because I have the CEO, the same of the two companies is the same. And yes, that is how SBA's rule works. So you do have to be careful with people way at the top that have substantive control over decision making and potential affiliation there. You got to look at the roles of those people, not their titles, and also if they have a similar title at other companies. So definitely something to look out for. Newly organized concern is the idea that you have a company that spins out, takes some owners or officers from the old company, starts a new firm. And the key here is that the old firm is giving assistance or contracts, monetary resources to that new concern. SBA, if all of the elements are met, can find that the new spun out firm and the old firm are still affiliated. So yeah, people come to us and they say, well, wait, my company's getting too big. This person wants to start a new business. Is that fine? It can be okay, but you have to be careful with the interactions between the old business and the new business. It also depends on, again, if they're high-level officers or owners going to the new company or not. So in some cases, you knock out one of those elements and you can reduce or remove the risk of affiliation, but it's definitely something to think about if you've got somebody that's starting a new company and if you're going to be interacting with them. And again, in that instance, sometimes the mentor-protege approach can be a good way to lessen the risk of affiliation if the old company serves as an improved mentor to the new company. Totality of the circumstances, it again, a little bit of a maddening rule because it says if there's no other affiliation rule that applies, it may apply. But I'd say you don't need to be too concerned about it. SBA does not apply it very often. But some things such as, sharing employees, bonding assistance, those can be factors in there. It's one of those where you kind of wish SBA would either get rid of it or define it better. But unfortunately, it's in the regulation. And it's something you kind of do have to deal with. Usually you find it where people accuse another company of totality of circumstances affiliation, and SBA says, yeah, it's not found. But still something to kind of be aware of. Okay, another quick poll question here.
All right. This is number 5. We'll have one more poll question near the end. This question, which of these is not a type of affiliation under SBA's rules? Common ownership, affiliation based on similar entity name, common management, or family member affiliation? And it looks like most people have voted. We'll give you a few more seconds here. All right, I'm going to go ahead and publish the result. And looks like most people selected B, bravo. Affiliation based on similar entity name is not a type of affiliation. All right, turn it back over to you.
All right, thanks. Oh, and someone did point out, yeah, the slide that earlier does say employees from a temporary employee agency do count for determining your employee count, which is kind of where we ended up there. Thank you for pointing that out. PEO might be different, is I think the idea there, than a temporary staffing agency. Okay, so we got examples for common ownership. Again, this is sort of the easy one. Small co owns 90% of company A. That same entity owns 50% of company B. Because it's 50% or more, that creates that presumption of affiliation. Then company A and B are affiliated by common ownership. Small co, which is the parent company, would also be affiliated with A and B. So all three of those companies would be affiliates under the common ownership rules. In this example, Jill owns 100% of company A. Jill owns 25% of company B, along with three other owners that also each own 25%. Jill controls company A through 100% ownership. Jill is presumed to control company B because of the equal minority ownership share. So then company A and company B are presumed affiliated because they have equal ownership and the individual interests are fairly large. Again, I give that example, and there's 100 owners, each on 1%. SBA is generally going to find that each of them controls that company as well. And this is an example based on identity of interest. Jack owns 100% of company A. Jack's mother owns 100% of company B. And company A and company B do business with each other. Then those two companies are presumed to be affiliated. And their receipts, for instance, would be aggregated. I did have an example where husband and wife had totally separate businesses. One was in engineering and one was in the medical field. They didn't do business together. SBA did accept that those two companies are not affiliated because the companies don't do business together. But if they're doing business together, then there is a high risk of familial affiliation. This is a different example of identity of interest. Company A gets 75% of its receipts from company B, for instance, as a subcontractor. Company A is going to be presumed affiliated with company B, although there are this exception in some cases, but that's one of those where you really need to watch those receipt counts. It's better to be under that 70% if at all possible. Okay, joint ventures. Now we're talking about an SBA compliant joint venture under 13 CFR 121-103. In that instance, SBA provides an exception to affiliation for the joint venture that is compliant with those SBA joint venture rules. So two small businesses, if each of them is small, can submit as a joint venture and they're not affiliated with each other. And that can be, small, an 8A company and a small business, for instance. Both of those are small businesses. Also, if the joint venture is a mentor and protege that have an approved mentor-protege mentor-protege agreement, then there is the exception to affiliation between mentor and protege if they form a joint venture. There's a 2-year rule for joint ventures, which, given our time constraints, I won't get into too much. But please be aware of the 2-year rule, which is still in effect for joint venture entities. Okay, a sensible subcontractor affiliation. What I will say about that is that if you have a small business prime, a large business subcontractor, there is a risk of ostensible subcontractor affiliation based on the subcontractor doing the primary and vital part of the work, or the prime being unusually reliant on the subcontractor. This is a type of affiliation that has caused confusion, I think, for generations of contractors. And recently, though, SBA has changed the rule a little bit. I think it makes it easier to comply as a small business. You're looking at what's the primary, what is the primary and vital part? What does unduly reliant mean? And there's a lot of cases that back up all of these definitions that made it, frankly, quite confusing. And SBA said you have to look at the totality of the circumstances, all the relationships between the parties, the proposal, the teaming agreement, a lot of different items. A rule in 2023 has said that SBA will basically find that the small business prime is properly complying with the ostensible subcontractor rule if the prime contractor is meeting the limitation on subcontracting. So don't have time to go in limitation on subcontracting, but we mentioned that earlier as part of these, as in response to one of the questions that for instance, if it's a services contract, the small business prime is doing 50% of the work, subcontracting no more than 50% to a non-small business subcontractor. If you're meeting those limitations on subcontracting, this recent rule seems to say you probably won't be found an ostensible subcontractor. I would like to see a case come out that has the same interpretation as me. We haven't seen that yet. It's the type of thing we would put on our blog immediately. So check out SmallGovCon for updates on that. So affiliation in general, you want to be aware of these things. You want to be aware of these rules, kind of ferret out the concerns with your company and potential affiliates, talk to your professionals, accountants, attorneys to think through these risks. And some of them can be removed if you change your operating agreement, for instance, or you sell a company, you can remove an affiliation concern that way. But definitely things you want to be aware of and tracking throughout your kind of the life of your small business as it hopefully just keeps making more and more money. You want to make that transition to a large business as planned as possible. And then briefly on protests, you can do an exclude appeal. Mention that you can challenge the small business status of a fellow company. If you want to do that, I won't go into all the details here, but there's very short deadlines. NAICS code appeal, 10 days from date of solicitation issuance. Size protest, remember, it's generally 5 days within award notification. So you have to do that very early on in the process if you do want to consider a size protest. Right when you get notice of the prospective awardee, you want to think about doing a size protest, if not sooner than that. If you do get a size protest yourself, make sure you're getting help and responding to those documents in a very timely manner. We've got one more poll question here.
All right. Our final poll question, and then I'm going to give Shane a moment to share a couple of other pieces of information about this firm. Let me click the start button. How much help do you need with your size certification? Are you confused? Maybe you have some idea. A little bit of help, I think I'm on track, or none, I'm good to go. And with that, Shane, if you want to jump, I know you've got a couple of good slides near the end to share some more info. And
yeah, for sure.
We'll let you close out. Yep. Give people just a couple of more seconds here to answer this last polling question. Again, we've got some more questions that if we can get to one or two of them, we will. Otherwise, again, we will share all of those with Shane, and he will be able to contact you with the answers to those. You can also contact him later if another question comes up. We'll go ahead and publish these results, and we'll just let you, I'll turn it back over to you, Shane.
Oh, thank you. Yeah, just a quick reference here to the handbooks that our firm puts out if you want to deep dive into some of these issues. Size and affiliation rules, we wrote a whole book on. I did a whole one on size protests and appeals. So as you can imagine, there's a lot of ins and outs to those processes. If you get into them, you want to be ready for it. Be ready to respond to SBA as a size protest, and be ready to kind of evaluate your own potential affiliation risks. And we can certainly help you do that if you have more complicated questions. let Robert mention
Yeah.
his book as well.
Yes. Likewise, we've got a book also available on Amazon. This is our Government Contract Accounting Made Easy. You can download the Kindle digital version, or if you like the good old-fashioned paperback, again, you can get both of those on Amazon.
Yeah, and I've read through that book, and it is, even for someone like me who's not an accountant, was able to understand it and learn things just in a quick review of that book. And there's our contact information. I mentioned our newsletter, and if you want to get updates from our blog, SmallGovCon, there's our newsletter link, or reach out to me on LinkedIn or email if you have any particular questions about your company and want a little bit more help. We can definitely set up a free call to help you out more.
All right, I want to say thank you, Shane, for joining us today and sharing some really good info. Thanks to everybody who joined. We'll have some information out very soon on our January webinar coming up. Until then, happy holidays to everyone, and we'll chat with you soon. Take care and have a great day.